higher and putting downward pressure on the gold price. So when things go bad, the gold price falls. Is this exactly what we're seeing right now?
Yes, in fact, it is exactly what we're seeing right now. And yeah, I even forgot that I wrote that. But yes, it is exactly it's what was happening then, and it still is what is happening now.
Welcome to the Power and Market Report. I'm Albert Liu. I'm very happy to welcome back to the program Paul van Eeden, who is president of Cranberry Capital Inc., which is a private Canadian holding company. Paul, it's been far too long since you were last on the program. Welcome back. How are you?
Thank you, Albert. I'm fantastic. Thank you. How are you doing?
Excellent. Excellent, Paul. You know, last time we discussed kind of in depth about the gold market, the correct call you made years ago when you thought gold had exceeded what you considered fair value. And I came back to you again hoping to get more of this type of analysis. Turns out that you're not doing specifically that same thing again. So can you tell the viewers, just remind them who you are and what you were doing and how that's changed?
Yes, certainly. So as you know, I spent a lot of time studying and analyzing the gold market. And in particular, I looked at gold from a monetary perspective. So my starting point was that gold isn't actually a commodity. It's a currency. It's a store of wealth, and should be looked at as money. And I spent many years studying gold from a monetary aspect. Back in the late 1990s, at the turn of the century, I was very bullish on gold. Gold was around $250, $300 an ounce. As you know, it went up to almost $2,000 an ounce. I became bearish around 2008, 2009. You know, I essentially got nervous about stock markets in 2008, as we discussed last time, and withdrew to a very large extent from actively investing in the financial equities. You're right, in 2011, when gold was, I think it was around 1980, I was very bearish on gold. And gold has retracted. I am somewhat neutral to bullish on gold at the moment. I've added gold back to my portfolio in a meaningful way, but I'm much less active in the actual analysis of gold at the moment because I've turned my attention pretty much towards other investment activities. To better categorize that, for the last almost 20 years, I've specialized in very, very small, very high risk nanocap companies that trade in, you know, the $1 or $2 million market cap all the way to 10 or 15 or 20 million market cap. But in the last few years, I've shifted my attention more towards larger cap investing, more towards capital preservation, and as part of that, I've also reduced my emphasis on macroeconomic analysis.
Okay, you know, I enjoyed our pre-interview conversation very much because it allows us to talk about other things. But just before we leave this topic, you've changed your sentiment on gold. You were bullish, then you were bearish. Now you've cautiously added more to your portfolio. You don't have the data that you used to have. So what are you using in lieu of that production data to, I guess, ground or reference your opinions on gold now?
Well, if you really look carefully at the models that I created, and I'm going to boil this down into a very, very simplistic form. If gold is money, then the inflation rate of gold from a monetary aspect is the amount by which the supply of gold increases every year. And that's simply calculated as the annual production of gold, because that adds to the gold supply, less the amount of fabrication that's permanently removed from the gold supply. That fabrication is not jewelry, because jewelry stays in the supply. That fabrication are things like electronics and dentistry. So we can look at the increase in the supply of gold by adding production and subtracting those aspects of fabrication. We can then compare it to, let's say, the inflation rate, the monetary inflation rate of the US dollar, which is the amount by which the money supply increases every year. Now, in an arm-waving kind of analysis, the US money supply is increasing by about 6 to 8% a year. The gold inflation rate, which is that difference between production and fabrication that's added to the gold supply, is around 1.5% a year, give or take a quarter or a half a percent. So let's say 1.5 to 2%. So that means gold is losing value relative to the US dollar at the rate of about 4 to 6% a year. In an arm-waving way, that's fairly constant. It doesn't change a whole lot. So if I miss data for a couple of years, it's not a meaningful difference in the analysis. Take the value of gold, add 4%. That's what it is next year. Maybe I'm out by 1%. But the fact that I don't have the detailed data doesn't change the fact that the model works, and I have very accurate data still for the US money supply. So even though I'm lacking the gold supply, for my personal use, I have what I need.
Okay, and this seems like a sort of a baseline appreciation of gold with respect to the dollar, just based on the supply and demand or production and consumption fundamentals. But you also have a changing public sentiment or a changing central bank sentiment where this trend that you've identified of 4% or so a year could be upended by a tremendous amount of gold hoarding, don't you think?
No, I disagree, Albert, because let's not talk about gold right now. Let's talk about money, US dollars. Let's say that there was $1 trillion in the money supply, and somebody decided to hoard some of that $1 trillion. They may temporarily change the price of the money, but they won't change the value of the money. I make a distinction between price and value. Price is volatile, set in the short term, but value is something larger, longer term, and more stable. So hoarding doesn't change value, it might change price.
Well, I think this is up for debate, but if we're talking about a permanent or semi-permanent long-run increase in the preference for people to increase their cash balances, wouldn't that in the long run increase the value of whatever money that we're talking about?
Well, let's look at a hypothetical. This is actually a very interesting discussion. Let's stick with US dollars just for a minute. Let's say that the CPI is running at 0% and there's $1 trillion. And all of a sudden, there's a propensity for people to hoard cash. And so instead of spending the money, they hoard the money. So the amount of money in circulation is effectively reduced by hoarding, and there's a temporary rise in the CPI because there's less money in circulation. Okay? So you might say, well, the money has become more valuable and it's reflected in the CPI. I would disagree, because at some point that propensity for hoarding will reverse. And when the dishoarding occurs, the CPI should reduce, assuming everything else is equal. Right? So the value never changed. The price changed in a short term, but the value never changed.
Okay. I think what you're calling value is just relative supply in units, correct?
No, it's not supply. Well, yes, sorry. Let me agree with you. It's the supply of units if we mean by supply the amount of units in existence. So by money supply, yes, how much money is in existence?
Okay.
So if you go to the kind of Austrian thoughts on money, the inflation, monetary inflation, increases the supply of money and thereby on a proportional basis reduces the value of money relative to goods and services. If by supply we mean that supply, I agree with you.
Okay. Okay. I want to move on because I think there's an interesting discussion that we could have about investing in these small companies and how you view investing in these small companies, given that you function as a private investor through your holding company, but you also have experience in corporate governance through your participation as a director. So
Yeah.
I want to start first as an investor, especially when you're investing in small, illiquid companies. Rick Rule has what he calls the 10 nosy questions for mining executives.
Yes.
That he thinks every investor should ask of these people. Do you have something similar? What questions do you like to ask when you're interviewing a management team?
I think Rick's 10 questions are very pertinent questions. And I don't have a specific list of questions that I ask, but I think I naturally ask many of the same questions that Rick would have on his list of 10. But I start maybe from a slightly different paradigm. One, I don't invest exclusively in mining stocks, so I would invest in technology stocks and other businesses as well. So the first kind of premise is the fact that if you're investing in a very, very, very small company, these companies are almost always by nature undercapitalized. They are cash flow negative and they are run on a shoestring. So that means that the probability of failure is extraordinarily high. And what we're trying to do is pick that one or two that might succeed out of an ocean of companies that are going to fail. So I would tailor the question specific to the company, what business they're in, and what stage of development they're in. And what I'm trying to ascertain is if I come from the assumption that the company is run on a shoestring, identify what's missing. What part of management is non-existent? What form of governance or controls and procedures aren't there? What's missing in the skill set? And then the determination has to be made, given what's missing and what is there, do I think that the company has a chance of survival or a chance of success, given what they lack and what they have? And so that's a slightly different paradigm than a set of 10 questions, because I don't think a set of 10 questions answers all the pertinent questions.
Okay. When I originally started speaking with Rick, because I come from a technology background, it struck me how similar the process can be at times, however, because, for instance, you talk about companies being undercapitalized. That is certainly the case with mining companies. These management teams are often standing on burning platforms, essentially.
Yes.
So this is the case in technology. What do you look for in terms of funding and whatnot? How much, I guess you measure it in time that you want to see? How many years do they have to operate, or how many of these stages can they get through? What do you look for when you're looking at the cash balance of a firm and deciding whether or not it's going to be adequate?
The cash balance and the timing that you're referring to has to be tied back to your investment time horizon and your specific reasons for investing and the milestones by which you're going to measure that. So mining is actually a very easy and simple question. Let's imagine a hypothetical exploration company that has enough money to last them for 2 years, and they've got some early stage exploration projects. Now, within the next 2 years, they have to raise additional money. So the question is, what can they do to those projects, and which milestones do they have to meet to demonstrate the viability of those projects, and is that enough for them to raise additional capital? So if it's a very early stage project and the management says, well, they're going to do some soil reconnaissance and some mapping and maybe a few rock chip samples or channel samples, that's not enough to generate sufficient interest to allow them to raise additional capital. If they say that they have drill targets identified. They're going to drill 20 holes, and you look at the targets and you look at the prospectivity of the project. Then you might say to yourself, if that drill program is successful, it should garner enough interest to allow them to raise money. But now you also have to have the technical skill to determine what does successful mean. What do you need to see in terms of the geology, the assay results? So exactly what does success look like? If you cannot determine that, then how can you actually even make an assessment as to whether 2 years worth of money is enough for this management team? And that's where Rick's 10 questions become handy, but that's also where working together with people who have very, very in-depth geological and technical skills becomes useful. Because the questions may be geologically in nature, they may be engineering in nature. Whereas, for example, if the project is at a deep valley with a river at the bottom, where are you going to put the tailings? Where are you going to put the processing plant? So even if you have a successful geological result, what is the engineering implication of that? You may be disappointed if they find high-grade gold and the market discounts that because there's nowhere to build a mine.
Right. Paul, let's now shift the discussion to a technology company. If it's a technology company, what milestones are you looking for? Are you looking for patents? Typically, what kind of milestones or results or questions to be answered are there?
It doesn't have to be patents, but it's a very similar process, because in a technology company, you have the kernel of a technology that's being developed or that has been developed. Now, in a mining company, we want to make a discovery, an exploration. In a technology company, we want to commercialize the technology. So what are the steps towards commercialization? How much is that going to cost? How long is that process going to be? And one thing you'll find in technology companies, whatever the management estimates the cost is going to be, it's going to be a lot more. Whatever they think the timing is going to be, it's going to be a lot longer.
Okay.
So you have to allow for that increase in cost and the increase in time frame, but then you have to ask yourself, does the management have the skill set to go through that process of commercialization? Because very often what you find in technology companies, if the founder comes from a technology or a science background, most of them have really, really difficulty in transitioning from research and development into commercialization. So there, the management skill set becomes much more critical. Is how are they going to address previously we talked about what's lacking and what's existent. In technology, it's critical to ask yourself what's lacking in this management team to take them through that process of commercialization.
Okay, I'm wondering though, that can take a long time from going from concept to full production. Are there intermediate steps that you look for that can demonstrate progress or unlock value? That's why I mentioned patents as an example. Are there intermediate steps that sometimes are applicable?
Personally, that's not my investment style. So I'm a much longer term investor in technology than that. So I look for technologies that I believe have genuine commercial value, and I typically have a time horizon of 10 to 15 years for commercialization. So as long as the company can demonstrate consistent progress towards commercialization, they should retain my interest. But if that process starts to fall apart, then changes have to be made. And those changes could be a change in management, it could be my withdrawal as an investor. But I don't look for short-term milestones like a patent or an FDA approval or anything like that as an exit or entry point. I'm trying to find companies that can genuinely commercialize the technology and become operationally successful.
Okay.
And Albert, there's a reason for that. And the reason is simply that the longer I look forward, so the longer my time frame becomes, the simpler the investment criteria become, and the higher the probability that I'll make the correct call. The shorter my time frame becomes, the more nebulous the criteria become, and the higher probability of failure. I found that true in all forms of investing. The longer my time frame, the more often I'm successful. The shorter my time frame, the more often it's a 50-50 probability over which I have little control.
That's interesting. One of the things Rick looks for is for the founders to be invested, to be partners and not just employees. When you're dealing with Nanocap or PicoCap companies, very small, what is your attitude toward the founders as partners, in the sense that do they draw salary? Are they earning sweat equity alongside you? What is your view on that?
So typically, I would like to see the founders having made a real investment. So not just a construction of a company in which the founders got millions of free shares, essentially just for registering a company. I want to see that their equity stake has something behind it, whether that's a contribution of assets, whether it's the development of a technology over a period of time, which typically in technology could be decades. There has to be a reason why they own stock, not just that they papered themselves up. I agree with Rick. I prefer that the founders have significant equity positions and that they're equity partners, so that our success as shareholders is tied to their success as shareholders. But I also recognize the fact that most people in the world have families and have lives outside their corporate identities. And so a founder, even a founder with a significant equity position, has to draw a salary. And the salary has to be somewhat market related. So I expect the founders to draw a salary. I expect them to be able to live off the salary so that they don't have domestic distractions and they can focus on the business. But I do want to see them with equity. In very small companies, regardless of the sector, if you have a purchased management team with no equity in the company, you probably have a problem.
Yeah. So in your experience, just summarizing this side of the discussion, I guess, what are the biggest problems you found as an investor investing in these very, very small technology companies?
Ego. Ego is the single biggest problem in technology companies. And the reason is very simple. Most people who develop technology are intelligent people. They're smart and they believe in themselves. That's why that's the only reason they're successful to the point where I meet them, which means that they've struggled, they've worked hard, they've developed something of value, and they did it by themselves. They believed in themselves. Okay? But they have to make the transition to commercialization. And more often than not, their ego is the only thing standing in their way, because they refuse to accept that there's something that they're not the best in the world at. And when you take an engineer or a scientist or a physicist, they're not necessarily the right people to run a sales and marketing division or to understand corporate finance or capital markets. They're intelligent enough to do it, but they may not have the personality to do it. And they need to either recognize that and employ the people who are capable of making the transition, or they need to be able to step aside, maybe move into a directorship or a chairmanship role and let other people come into the organization to manage that transition. So the single biggest problem in very small technology companies is ego.
Paul, if there was any doubt in my mind as to the authenticity of your experience, those have been laid to rest. This person knows what he's talking about, people. But Paul, your experience goes far beyond that of an investor, which is part of the reason why I wanted to have this conversation with you, because you told me at one point that you had an interest in sort of the process of corporate governance and wanted to experience it from the side of a director. So
Yes.
can you tell the viewers a little bit about your experiences there? What precisely motivated you to do that, and how did you go about achieving that?
Yes, as a private investor in a lot of these very small companies, I sometimes observed that decisions were made at the board level which were counterintuitive, and I was curious as to why is it that a company that on from the outside appears to be properly structured would end up making decisions which are counterintuitive. And so I wanted to understand better the process of corporate governance in public markets, specifically as it relates to these very, very small companies. So I put myself out there as a potential candidate for a couple of board positions, and I've been on several boards over the past few years, and it was a very interesting experience. So the one thing that I'll say is that from that I've learned as an investor that if the board is picked by the chief executive officer, you should be careful. You really, really, really need to have an independent board. And it doesn't matter who came first, the board or the chief executive officer, but you have to have an independent board. It's not always easy from the outside to determine the level of independence, but with some work and some conversation, you can usually start to get a sense of it. If you find that your board is beholden to your chief executive officer, you have zero corporate governance, I shouldn't make that statement so blatantly, but you have a risk of a deficiency in corporate governance. With regards to corporate governance, in particular in these small companies, there are people out there who hold themselves out as, I would want to say, professional directors, except they're not very professional. It's just that they're on a lot of different boards. And the problem with these small companies is that the directors are poorly compensated. Often they make very little cash and they get some stock options. The nature of these companies are that for most part the stock options are worthless, which means that you're employing a class of directors who are perhaps not the best directors the company could find. So as a private investor, I would look at director compensation and ask yourself, are these directors actually being properly compensated in a manner that allows the company to attract a high level and a high quality director? So you're looking for director independence and proper director compensation so that you know that you've got a functioning board. If you lack one of those two, you run the risk of having a company with poor governance and a board that's not truly independent of the CEO.
So Paul, I think that you would agree that one of the characteristics of an effective CEO would be someone who sees the board as a resource, basically, and not as a rubber stamp or some obstacle that needs to be overcome.
That is absolutely true. And Albert, that is a very astute observation, because if you have a board that is rubber stamping the CEO, aside from the fact that you have no governance, you have an enormous lost opportunity. People who typically serve on well-functioning boards are people with diverse industry experience and relevant experience relative to the companies. And the CEO absolutely has to use the board as a resource, as a sounding board. And different board members fill different functions. So depending on what the CEO is struggling with at the time, he should ideally have a board member that he can go to for advice and assistance, or if not direct assistance, a board member that can put him in contact with the correct advisors for whatever problem he has. That is a proper functioning board. And you can get that in these small companies. It's just not prevalent.
Just a minute or two left, Paul. What, in your experience as a director, what qualities did you find to be most valuable and perhaps somewhat rare in a CEO?
That's a very good question, and one that's hard to do in a minute. Um,
Fair enough.
Again, and these small companies are somewhat unique and very, very different from larger, mid-cap to large-cap companies. In these small companies, because they're undercapitalized and because they're always run on a shoestring, if you're looking for what can make a company successful, different CEOs with different personalities bring different things to the table. So you may find a very, very good promoter. Well, that means that he has access to capital and he has a low cost of capital. But you may equally find somebody who's not very good at promoting, but he's very competent technically. All right, that means his cost of capital might be higher, but his technical risk is lower.
Let's stop right there, actually. Which do you think would be more important if you had to choose for a CEO?
I don't think that you can say one is better than the other. I think as an investor, it's just very important for you to understand which one you're dealing with, because it changes your risk parameters and it changes the milestones that you need to look for success. If you have a very good promoter, but he cannot achieve technical success anywhere in the path, you need to at some point exit. And the same thing, if you have a very competent technical CEO, but he cannot get to the point where he can raise capital, you also need to exit. So it changes your parameters. But there's a third kind, and this is a person who's a very good a corporate organizational person. So somebody who can really surround himself with all of the expertise that he needs and hold it all together and manage it effectively and efficiently. Of all three, he's the lowest risk because he's the one that can find the right technical person, that can find the right promoter, and he's the one who can hold it all together and run the organization efficiently. And there you have the kernel of a company that may be sufficiently successful to become a viable business. The other two guys have to compensate for their deficiencies, and you need to be aware of where and how they do that.
Very good, Paul. This has been a very interesting discussion. Unfortunately, we are out of time. So I want to thank you very much for taking time, coming back online out of hiding. I know the viewers appreciate it, and I appreciate it very much. So thank you.
Thank you, Albert. It's always a pleasure.
My guest has been Mr. Paul Van Eeden. He's the president of Cranberry Capital Incorporated. That's a private Canadian holding company. Please let me know in the comments section what you thought of this interview, and if you'd like to have Paul back and talk about another topic. I'd love to hear other ideas for topics with Mr. Van Eeden. That is the Power and Market Report for Friday, September 16th. Thanks for visiting. Till next time, take care. Hi, I'm Albert Liu, host of the Power and Market Report. If you enjoyed this video, I invite you to subscribe to my channel by clicking the button on the top left of the screen. And don't forget, you can also visit us on Facebook and at powerandmarket.com. Thanks again for watching.